Okay, great. All right, it is 3:18. Oh, wonderful. Thank you. I appreciate that. I'm going to follow along with the slides here on my own, and I won't be able to see much of the chat, but I'm going to try and size it on my screen so I can at least see a little bit. Thank you, everyone, for taking some of your valuable time to hear me talk a little bit about some interesting alerts that I found inside the Unusual Whales data sets. The slides are linked inside the chat if you'd like to follow along. Otherwise, I'll be talking through them. So first and foremost, first slide, big reminder, this is obviously not financial advice. I am not providing anyone any financial advice. Thank you for reiterating that. But with that, let's go ahead and get started. So first slide here, long whales do it better. When I looked at all the out of the money call alerts when by outcome, and then I split up the data into admittedly a little bit arbitrary date ranges, I found that the longest range out of the money alerts had the highest likelihood of success. So if you look at this chart right here, you can see the first group all the way on the left is the alerts with 7 days or less until expiration. The next column is 8 to 28 days until expiration. The third column is 29 to 90 days till expiration. The fourth column is 91 to 180 days until expiration. And then finally, the last column is 181 days or more until expiration. And this chart really jumped out at me when I visualized the data this way, because that nice deep green bar at the very top is the largest, both in terms of percentage of the whole set and also just in sheer quantity, right? In sheer number. There were 184 of those. And what you're looking at up there is something that I called a strict winner. So a strict winner obviously is something very good, and we want to make sure that we're doing everything we can to expose ourselves to strict winners when it comes to Unusual Whales alerts. And this group had the highest percentage of strict winners. And so I decided, okay, cool. I'm gonna look more deeply at this group and see what I can learn. And here on the next slide, I'm just going to get straight to the point because I know people are busy and they might not necessarily have lots of time to hear me explain how all this was derived. But essentially, the mechanics of this strategy are to only examine out of the money call alerts with at least 181 days until expiration. On reviewing an alert, if the alert original spot price reaches a minus 20% return, you want to skip it. Just forget about it, bury it, whatever you want to do. You're not interested in that alert anymore. You want to keep alerts on your watch list for about 7 days at most. And you only want to buy an out of the money call alert or attempt to recreate the whales strategy in a bullish way if and only if the original alert spot price reaches a plus 30% return. Your exit strategy can go one of two ways. Unfortunately, they can't all be winners. You need to cut your losses if the original alert spot price falls down to minus 20%, and that's our bad outcome. We want to avoid those, obviously. And in the best case, you want to take profits in the 50% to 100% return range, and that range is based on the original spot price of the alert when the alert occurred. So all this talk is all fine and good, but it would be kind of a jerk move of me if I didn't share the tools you might need to follow this strategy. So on the left, that link is my Unusual Whales alert filter. This only looks at out of the money calls with at least 181 days until expiration. And then on the right, I'm tracking all of them myself personally inside a Google Sheet, taking notes about what I see, flagging things that might be interesting, maybe not. There are some extra columns in there you might see that are unique and are not tracked inside the Unusual Whales platform. I'm tracking them because I figure they might be interesting. And if not, oh well, I spent a few seconds on all these writing it down. What could it hurt? Okay, so a little bit earlier we talked about outcomes, and the two that I really want to focus on in this strategy is number one, on strict winners. Hopefully the name is very, very obvious and very clear. A strict winner is an alert that reaches plus 20% on the alert price, and that strict winner never declines return-wise to minus 20% inside the 6-week historical period that exists after the alert. And this is a really important consideration here, because we're dealing with extremely long-term, at least in terms of options. We're looking at very long-term expiration cycles on these. And in case you have not looked at the end of month alert reports from the kindly Mr. Whale, he can't provide infinite time history on all of these alerts, right? He has to eventually say, okay, enough is enough. Here's the data you're going to get. And most months you get about 6 weeks worth of data. In some months it might be a little more, in some months it might be a little less, but in the very best case, you'll get about 6 weeks of alert performance. And so this is important to recognize here. I only have 6 weeks of data at the very most for an alert after it was flagged and logged in the Unusual Whales system. So the timeline on this does not require that you hang on to these for 181 days or more, but we'll get to that a little bit later. The second type of outcome is what I've called a swinger with positive first direction. So a swinger is an out of the money call alert that either goes positive first and hangs out there for a while, so it reaches 20% return on the original alert price. It might go higher, it might not go higher. And then unfortunately, that same alert then drops to minus 20% inside the same 6-week period. So these alerts, while inevitably kind of a bummer if you're going to hang on to them forever because they will at some point go negative, they initially go positive. And that's really helpful for this strategy because we want to narrow down our field of possible contracts as quickly and as effectively as we can. And we're only going to follow alerts that go up first. So that's going to be our focus, right? We want to focus on alerts that have a positive return and start going up right away rather than those that go down. And this next slide here is exactly more emphasis on the outcomes we want to avoid here. So a strict loser, again, hopefully the name is very obvious. A strict loser is an alert that reaches minus 20% return on the alert price and then never climbs back up to plus 20% on the original alert price. So we want to avoid these at all costs, right? All you're going to do here is lose money no matter what. The other two outcomes we want to avoid are what I call a strict dud, which is an alert that never reaches plus 20% or minus 20%, which is essentially misallocated capital. It's just not a good use of your money. And a swinger with negative first direction. A swinger with negative first direction is simply the inverse of a swinger with positive first direction, except it goes negative first, and then at some point in the future, it reaches plus 20% inside the 6-week period. However, these are inevitably risky because you'll recall that anything that goes negative first might turn out to be a strict loser, at least in the 6-week history that we have. And a strict loser is just going to lose you money, right? So I don't want to work with swingers with negative first direction, at least not until they hit 20% later. And maybe we'll come up with a cool strategy around that. But for the time being, they're to be avoided because a swinger with negative first direction, at least if you think it might swing back positive, it could wind up being a strict loser. And there will be strict losers. Let's make no buts about that. There will be alerts that are only negative in the entire history. If you remember all the way back on the first actual slide, not my title slide that says 181 DTE, the one with that colorful bar chart, there is a big thick red bar at the bottom of each of these groups. And we want to avoid that red bar at all costs, because all that red bar is going to do is lose money. And I don't want to lose money. I'm bad enough at trading as it stands. I'd rather use some other tactics and maybe not lose money on something that already started to go down. Okay, so moving right along. The most intelligent amongst the group are no doubt thinking to yourselves, well, this is all fine and good, but I don't have 100 million years to wait on a potential return. Why should I be interested in very long-term options? Well, fortunately, you don't have to wait forever for these to start making moves and potentially making you money. If you look at the chart associated with this slide right here, I realize it is a little small, so my apologies. But if you squint really hard, you can see that the second day, right, not like group 01 next day after alert, is the median outcome for the big four potential outcomes inside the data set. So typically, by the day after the alert, at least the median, as far as the median is concerned, you're gonna see that alert either go up 20% or go down 20%. Remember, if it goes negative first, we just want to skip it. It's not interesting in our strategy. So as soon as something drops to minus 20, I'm not interested anymore. I mark it as down. I don't care. I'm moving on. As soon as something gets to plus 20, now I'm a lot more interested, and I'm going to start watching that a lot more closely here. In the next slide, we're going to talk about something that I'm sure the most keen of the listeners here no doubt picked up. You heard me just talk about 20%, blah, 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 20%. But now in the strategy, you'll recall that I said, you got to wait until it goes up 30%. And you're probably thinking to yourself, this guy's an idiot. Why is he telling me two different numbers? He obviously didn't do his math correctly. The reason you want to skip that 20% threshold is because there's a lot of pain in that 20 to 30% range. If you look here on this slide and you zoom in a little bit on the call swingers with positive first direction, which are the blue charts, you can see that 49 of all of these occurrences, which is approximately 30% of the data set, only reached the 20 to 30% range before they flamed out and went negative. And that is absolutely something I want to avoid. And if I can avoid 30% of these swingers that are only going to go up 20% before they drop back down and start to go negative again, I'm going to do it, right? The 20 to 30% range is like the last final threshold you want to get over. I intend to skip all these personally because there are a lot of them. It's 30% of the data set. And if I can, again, narrow my odds down even further of tailing a very well traded whale, then I'm definitely going to try and do that. And so in the smaller chart on the right, you can see that by skipping this 20 to 30% range, we skip this big group of call swingers with positive first direction, and we also skip a relatively small group of out of the money call strict winners that only made it to the 20 to 30% range. So we're essentially weeding out even more of the less ideal outcomes there. And so coming around to the home stretch here, we're talking about the end of the strategy. Why should we take profit at 50 to 100%? Why don't we wait until it goes up 1,000,000% or whatever? Well, The reason we want to take profit in the 50 to 100% range is because the median max gain for both out of the money call swingers with positive first direction and strict winners is 50 to 100%. The strict winner 50 to 100% range, that technically might be low, because remember, we're dealing with contracts that have 181 days to expiration, but I only have 6 weeks of performance to look at. So maybe those 50 to 100% go further up over time. Maybe they don't, maybe they just sit there. That's the median outcome for the strict winners based on the 6 weeks of history I have available. And the really important part of this 50 to 100% group is that you have to recall that what seems like a strict winner might actually be a swinger with positive first direction that eventually is going to turn on you and go negative. And remember, we really want to avoid that outcome because it involves you losing money, or it involves me losing money, because I'm doing this strategy myself right now. And if that happens, that stinks. You lose money. I don't want to do that. And as it turns out, the 50 to 100% range is the maximum gain before reversal, the median max gain before reversal in the swinger with positive first direction group, which really works out so perfectly for someone who is already a slave to my emotions. And I totally do dumb stuff when I'm trading, and I don't execute my plan so perfectly. So having a nice range to target is something that I think is really helpful. And my hope is that by giving myself a range, I can kind of make these trades a little more automatic and make myself maybe less of a slave to my emotions, which are totally dumb. Cool. Okay. On to the last 2 slides. 11 or more days is the median time to a reversal of a call swinger with positive first direction. And it's also the median time to the maximum gain for a strict winner. Again, this is really great. They're both the same date range. I don't have to think about different outcomes or different strategies based on what I think is going to happen with the alert. On average, you have more than 11 days for this trade to take place, and your outcome is going to occur most likely in that 11 plus days range. Now, I realize that this might be kind of painful if you're used to much faster turnarounds. If you're like a weekly trader, or you're a day trader, scalper, someone like that, this strategy just might not be for you if you don't want to wait for potentially 11 or more days for your outcome to arrive. But for someone like myself, who's pretty busy during the day and I can't always be very attentive and active over my account, this is actually great because I have lots of time to see what's going on, adjust the trade, maybe scale in or scale down. I like having more time to make some moves and see how the trade elapses rather than having less time and needing to more actively tend to the trade and be very attentive on the account. So the big takeaway here is that the median time to your outcome is more than 11 days. So you should plan on holding these for some period of time and be aware that you might see minor ups and downs over time, but in general, by focusing on those that have only reached that 30% threshold, you're positioning yourself to tail whales with a very high success rate. And so finally, rounding home here and finishing it all up, you might be thinking to yourself, well, this Wagner guy is kind of an idiot. I can just hold these forever. I have a cajillion days on my contract. Why should I sell it if it starts to go down? And it's true. You could hold it. You probably have like 5 months or more on these contracts. And if you want to ride it out, that's great. It's your account. You can do with it as you see fit. However, one word of warning: inside the 6-week period that's available, 116 of the 166 swingers with positive first direction, right? Because that's what we're talking about. If it goes negative, right, you're definitely dealing with a swinger with positive first direction. 116 of 166 of them, which is 70%, have a final direction inside the 6-week period that is less than zero. And remember that if you got into this trade at 30% above the original alert price, your loss is going to be greater than 30% here, right? It's going to be like 50%. So if you want to ride it out, you should feel free. But inside the 6-week period, the data shows that these alerts tend to end the 6-week period negative. And unfortunately, I don't have any more insight into how they perform longer term without having to like manually review thousands of them from the website itself. And I don't unfortunately have time to do that. And so that is the end of the 181 DTE strategy. I will go ahead and open it up to questions here. So this is actually, yeah, questions via, yeah, voice would probably be really good instead of forcing everybody to type them all out. But I am so new and bad at this. I wouldn't know how to. Okay, beautiful. Thank you. I appreciate. Yeah.
You'll see that little hand down there as well. It says request to speak for you guys. Do you want to raise your hand? Yep, just like that. And you can step up and ask a question.
Cool. Yeah. So questions welcome. Anybody who's interested. Okay. Here we go. Okay. Invite sent. Tourney Gaming. What up? Yeah, absolutely. That's it. So okay, great question. All right, so the spreadsheet. If you're looking at the Google sheet, you can see I kind of have developed my own system. It's probably not great for everybody, but feel free to follow along or modify it as you see fit. I'm typing in information about each alert as they come in. So the yellow highlighted ones are the trades that I'm still in right now. And the green highlighted ones, except for this, there's like a block of yeses that are highlighted green. I'm not sure what I did there. That was a mistake. But the rows that are highlighted greens are trades that I want to get into because they've met the criteria. And the ones that are the ones that I have finished, either I like wrote down what my entry was and how it worked out, or in some cases, in column L, I might have marked missed, and in a lot of cases, I might have missed this because, again, like I mentioned earlier, I totally suck, and maybe I'm not looking every day, or I was super busy during the day doing some day job work, and I wasn't able to execute on some opportunities, or I didn't check these for a few days in a row, and that totally stinks. But so far, I am net positive on the trades that I have entered. So some of the losers that I've had right now. Okay, so first trade I got into was EPD. That was a winner. I got in at $1.06 and I sold out at $1.48. Oh, I have a small account too. So I'm not buying like 50 contracts on this or anything. I'm buying like 1, maybe 2 contracts. And then we'll see, sort of how it goes. I'm sorry. The first trade I actually got into was Bank of America. And I got in at $1.03, and that one turned on me, and I got out at 69 cents. So that one was a loss. I'm keeping track of like losses and gains, notional gains and losses in column W, and percentage gains in column X, so you can see how those went. The Bank of America one was a bummer. That didn't work out. I lost on that one. Then I got into EPD. That one was a winner. So this Ford one really gets my goat. It's in row 31 if anybody's following along with this one. So this one, God, man, this is so annoying. All right. And this is, again, as I mentioned before, I'm a total slave to my emotions and I suck. And I need systems like this, or else I'm just going to behave like an idiot. So I bought two of these contracts at 64 cents because they're relatively inexpensive, and that fits my account size really well. And when it dropped down to 48 cents, I was like, oh shoot, this is the exit, time to take a loss. So I sold out of both of those at 48 cents a piece, not paying attention in column N, where I have that 20% stop, that the actual stop out price was 42 cents. And since then, you could look in the notes where I have some not great English because I can be a little rough sometimes. Those calls have since more than doubled, right? So by not paying attention to what the actual stop is, I missed out on more than doubling these. So this one was a loss. I'm not going to cheat and give myself credit or give this strategy any more credit than it might deserve, because I don't want to benefit myself too much. But this one would have totally been a winner if I wasn't an idiot and sold out at the wrong price. So that was a bummer. So the next few that are highlighted green, I tried to get into, but I couldn't. They got up to like 50% or more. And I wasn't able to get filled on them. Sometimes if the contract is moving fast, I might not get filled. And while that's a bummer, I figure there are always at least 3 or 4 of these, if not 10, every single day. And so I figure there's going to be more in the hopper. So that'll be cool. I'll get on it later. I had success with SU. I'm forgetting what that is. It's like something sun. It's like a solar company, maybe. I don't know. I made $20 on that one. That was pretty cool. XBI, IWM, and BBIG. I missed out on those. BBIG, the alert on that one, if I remember correctly, was like totally ahead of when all that squeeze action started to happen. So I'm sure I missed that one or I wasn't paying attention that week. Again, like I mentioned before, I totally suck at this. Let's see what else we got here. Yeah. Okay. So like KBO is COG, like a natural gas trade. I missed that one. That sucks because those are exploding right now. Another SU trade that I missed, the spreads were really wide on that, so I couldn't get in there. In general, the strategy is up, but it would probably be up some more or maybe down if I executed it well. And I promise I'm trying my hardest, but I'm not executing on it really well. And that's generally a problem. But the one final thing, and I'm sorry about this like ranting and raving response here, but the final thing I want to talk about and my hypothesis for why this whole strategy works is that I believe that these whales, this professional money, I think they are extremely good at buying dips. And I also think they're extremely good at identifying sector rotations at least before I can. Right. I'm sure there are tons of really great traders in here who know what they're doing and who are better at identifying the next move. But I'm going to rely on these whales to kind of pick that information for me. And you'll notice here in recent weeks here, so PBR, Petrobras, that's Brazilian oil, that started to pick up. Intel, I'm not exactly sure. I mean, the trade is going well and I'm up on it right now, but that one was a winner. The whales picked out Bank of America, Morgan Stanley. I had to miss this one because it got away from me so fast. The whales picked out XOM. So like the whales were kind of ahead. If you look at these dates, these alerts started on the 21st, which was last Monday. So if right now I'm hearing in financial news outlets that there's this huge energy rip, that these energy companies are doing really well, and that financials are also doing really well right now. And you'll notice like Bank of America, Morgan Stanley, XOM, uh, Schlumberger, right? SLB. I missed that one. It got up to 100% before I could get a fill, which was kind of rude. There's like, I think my hypothesis, which I still need to test across a variety of different ways, but my hypothesis is that the whales are really good at spotting sector rotation, and they're really good at timing bottoms. Yeah, okay, check this out. BP and Cabo, another Bank of America, right? Like Bank of America, lots of activity in space that's hot right now. And maybe right now, by the 27th, maybe it's kind of obvious that there was this rotation into oil and banks. But I again, it's my hypothesis. I don't have any proof of it yet, but my hypothesis is that whales are good at picking bottoms and front running sector rotation. Oh yeah, well, I appreciate thanks so much for the kind words. I appreciate it. Happy to help, and I'm always happy to like work on a strategy. Hopefully that's helpful to other people. I'm very new in the options world and to like trading in general, right? Like I've always been an investor, but I've never actively traded options so much. And so it was very interesting because Mr. Whale made all that data available, and I was so excited to be able to look at it. Okay. Next time I get a question, I'll try to rant a little bit less, but I'm glad that one came up because that did touch on some things that were that I thought were pertinent. But again, that whole dip buying and sector rotation hypothesis is just a hypothesis. I have not tested it yet, but I suspect that it is that that whales are very good at identifying those trends. So are there any other questions? I could invite people up, or I can look in the chat too. Okay, all right, great. I have a oh yeah, okay, great question. What prevents any one of us from just tracking these ourselves? There's nothing. You could go track them yourself. Do great. Like please, if you update the spreadsheet, that's awesome. Or update your own and screw me, right? Because I'm just some guy. But yeah, that would be great. I love having some help on these. When the day ends and I have like a list of things to do after work, I sometimes I'm just like, oh yeah, and then before the end of the night, I should look at the alerts. And then like sometimes it just falls off my to-do list. I like working with spreadsheets and tackling these kinds of interesting problems, but also I can be my my own worst enemy when it comes to tracking these. Like right, like if you go look at some of these most recent ones, 921, 922, 920, there are misses, like very obvious misses, right? BP, a BP super leap in 2024, it got to over 100% before I could enter. Well, maybe I didn't get a good fill, or what's more likely is that I just didn't look at it for a few days because I stink, and that's like, I stink, and that's the whole problem there, right? And same with some of these other ones, right, that are super in line with that recent rotation. Morgan Stanley, I missed that. One of my buddies is like a total Morgan Stanley bull, and he was talking about it, and I ignored it or didn't take any action, again, because I suck at this. XOM, and yeah, and then Schlumberger. So, okay, cool. I see a question here that says, is this presentation recorded and can it be listened to again? So I am recording this on my own personal Zoom right now. Hopefully it's going to be out there, and you'll be able to actually see me putzing through the slides as well. But if not, it'll just be an MP3 or something like that, and it'll be the world's least interesting podcast. Okay. Can you talk more about how you settled on the days to expiration? Yes, I can. I talked about it with Snorlax one time, and we were like, what should we break them up into? And I just picked those numbers. As much as it might seem like I'm some cool data whiz or whatever, I just picked them. I was like, okay, super short weeklies. I lose on those all the time. So I want to bucket those together and be like, okay, what are the ones I should probably avoid? And then I said, okay, how about like a month, which was 8 days to 28 days. And then I said, okay, like 29 to, I don't even remember, 29 to 90. So the true answer to that question is I just picked them. There was no scientific strategy for doing so. And one of the more talented data folks inside this room could probably do a much better job by not arbitrarily picking date ranges and instead selecting some statistically significant, like bucketing or something like that. And so that is the answer to that question. I'm not going to BS anybody about that. Okay, Dominican Rick, do you buy the exact dated option? That is a great question. Like 181 days out. Yes, normally I do if I can afford to do so. Now, unfortunately, some of these leaps are for expensive stocks that I just can't afford the leap, right? My account size is not big enough to spend like thousands of dollars on one single trade, right? It's like way too risky. If it goes down, I'm going to lose half my account or whatever. So I still want to simulate the bulls, this like the bullish thesis though. And what I will do in that case is I will buy a spread. And normally when I'm trading shorter term, I like to use put credit spreads because I am like not so good at picking direction, and I am benefited by not by having lots of potential avenues for success with a put credit spread. But when I'm going super long term, I will buy a call debit spread rather than a put put credit spread. Okay, I'm going back up here for more questions. Yeah, like 181 days out. Yes. Yeah, I do. If you were to look at my Tasty trade right now, you would see that I have like a big block of trades that have 181 days or more left until expiry. And the beauty of this strategy, if you go back to the slides on slide number 2, I only had 6 weeks to look at these. So I'm tracking their performance over 6 weeks. And you can see that there's this preponderance of winners inside the 181 days or more group. And more importantly, if you go to slide number 9, not number 9. Oh gosh, I'm so sorry. Oh yeah, it is. It is slide number 9. So if you go to slide number 9, where I show you all the gain ranges, the gain range was still 50 to 100%, even though it was still within 6 weeks. So who knows? Maybe these out of the money call options will wind up going up 1,000% 9 months later. I don't know. I only had 6 weeks to work with. So I just used the data that I had, and that's how I settled on 50% to 100%. So if you want to develop your own thesis around this strategy, and maybe you're like buying more contracts and you scale out and hold on to some or something like that, that's a perfectly valid way to do it. I love it when people take ideas and kind of remix them and make them better. That's totally amazing, and I strongly recommend anyone and everyone trying out this type of strategy with their own little flair for it. I'm just gonna, for the time being, at least until like I have a bunch of more trading money and I can allocate a little more risk. I'm gonna be trading like a relatively small number of these contracts, and I'm gonna be exiting somewhere in the 50 to 100% range. Okay, let me see here. I'm gonna look in the. Okay, I have no request to speak, which is totally fine. I'm happy to keep fielding questions if they come in the stage chat. Still not bad. 50 100. Yeah, totally. Right. Like a lot of times, a lot of my dumber trades don't make 50 to 100%. They make -% So, 50 to 100% range is wonderful, and I love it. Okay, let me see here. Okay, all right. Remember coming up. Let me invite Meg HNA up to speak. Okay, invite sent. See if you pop on here. Doke.
Mr. and Mrs. Megna, you're going to have to accept the invite in order to speak.
Thank you for that. I should have said something. Okay, another good question in the meantime. Dr. Stoss, that's a great question. And at this time, the answer is no. I would like to look out further, but there's like a kind of a unique problem with this data set, or it's not a problem, but there's a uniqueness inside the data set that I wasn't able to include inside the 10 slides I set a limit for myself for. So okay, that's a great question, right? Why didn't you go look at 20 days, go look at 30 days, go look at 45 days? So unfortunately, for many of these, the problem is that the alert occurred on like the 28th of the month. And I only have 2 weeks until Mr. Whale says, okay, right, chop, that's the end of this data. That's all you have access to. And so immediately, I'm sure lots of very clever people are thinking, oh my God, Dan, you obviously just boboed this whole thing up. If you're not including, or if you're including all these super short-term histories, you definitely are not looking at the proper amount of performance. Oh my God, let's throw the strategy in the trash. You're an idiot. I hate this guy. Oh, I promise I thought about this. Any alert that didn't have at least 7 days, like a full calendar week's worth of data, I threw out of my analysis. I said, you don't have enough historical information for me to evaluate whether or not you were a successful trade or not. And so with that, I was like, okay, get out of my data set, right? Those transactions were ignored. And so unfortunately, as you reach the end of the month, more and more alerts get thrown out of the data set simply because there isn't enough historical data sometimes available for those trades to be analyzed. Now, fortunately, Mr. Whale is a kind and giving whale, and he often delivers about 6 weeks worth of data. So those end of month alerts still have 1 to 2 weeks of performance. And if you'll recall from the slides, you saw that a lot of action does occur inside the first like 10 to 15 days, not only in terms of reaching plus 20% or minus 20%, but in a lot of cases also reaching the max gain range, or max gain before turnaround, right? So I did the best that I could with the data that was made available, and unfortunately there's just like a challenge associated with having these like monthly snapshots of alerts. But that's a great question, and I'm really glad it came up. That was a great one. Okay, cool. Meg, thank you for Magna. Thank you for accepting. What's up? If you are asking a question, I think you might be on mute. If there's a way for you to like unmute, I can only mute you, and I don't want to do that. Oop. I'm so sorry, Magna. I clicked on what I thought was the unmute button, and I think that just kicked you out. I'm the rudest host in the history of time. Okay, all right. I saw okay, but Magna, I will please, give me, I will kindly please come up and ask your question again, or type it in the chat, or whatever is going to be easiest for you. Okay. All right. Good to know. So thank you for the scoop. Okay. Do you have any tips on how to keep track of the percent gain of the original alert when you're buying at plus 30% and getting out at 5,100%? Great question. I do. And I built it right into the spreadsheet because I am, like I said, I'm like horrible at every part of this thing. So if you're looking at the spreadsheet and you scoot on over to column T as in tango, you will see that the 50% over spot price is listed there. So as I'm like eyeing these up and I'm thinking, okay, it might be time to take some profit here. I am looking for that. I am looking for that number. Sometimes inside Tastyworks, I'll actually just set a bracket if I'm able to. If I just bought a call, then I'll set a bracket order that'll sell it around like 50% or 51%, something like that. But if I had to put on a spread because the original bullish strategy was too expensive for my tiny little baby account, then I just try to watch the spread kind of closely. It is it's not as far as I know inside Tastyworks, I can't set a bracket order on a spread, and so I just have to watch that one a little bit more closely. Okay, coming in later, are you buying 100 days out options? Yes, I am, or at least I'm trying to. At the very least, I'm trying to simulate the bullish, what I interpret to be the bullish thesis of the original alert, because in some cases they're buying like a very expensive option, and I can't afford it because my account is relatively small, and I'm not willing to risk a huge part of my trading portfolio on a single trade. Okay. Oh, okay. May, you're back. Great. Meg, what's up? Wait, hold on. I got a DM from you. Can we use your spreadsheet for future trades? Yeah. Oh, for sure. I use whatever you want. Just make a copy. Don't if you wouldn't mind not busting mine up. I think it's set to, if it's set to view only, feel free to make a copy, or I don't know, DM me about something else and we'll try to make something work. But I am always a little nervous about having a public spreadsheet that people are in and adjusting all the time. Yeah. Okay. Perfect. Wonderful. Okay. It is view only. Yeah. So temporarily I would suggest going in there, making copy. This information is all public, and more importantly, it is also not financial advice. So you are free to do with this spreadsheet as you see fit. Okay, more wonderful questions. Okay, great. Do you ever find a reason to hold runners as it gets closer to 45 to 90 days to expiry, even after it hits a 50 to 100% raise? I do in hindsight. Let me tell you, I sold I sold the Bank of America trade that I got into, and now it's way up over the 51 or 55% profit that I took. It was yeah, right. In hindsight, I sure wish I did. I wish I had more money, because then I could buy a bunch of contracts and then scale out like a real pro. But I don't have a huge account, so I'm just doing what I can, and maybe I'll deliver DoorDash on weekends and make some more money, and it'll be sweet. And I'll have more money in my trading account, and that'll be super tight. Okay, I got another hand raised from Limitless, and I want to invite. Okay, invite sent to Limitless. Yeah, I can hear you. What's up? Yes. I have not, but that's a great idea. Right now as it stands, I've definitely done some noodling about oh, I should, how can I modify and improve this strategy, and calendars have definitely have kind of crossed my mind. But right now, candidly, between you and I, my man, I I just suck so bad. I'm like, oh, I didn't look at my things today. Oh, I didn't open up Tasty until lunchtime, and I bunch of orders didn't fill, or what, you know what I'm saying? I've just been doing such a bad job of implementing it. It's shameful, really. But calendars sound like a great idea. I mean, sure. Yeah, it's a totally great idea. I absolutely, I love it. I'm with you totally on that. That's a great idea, and I'm taking submissions. You know, like if people can help like refine this strategy or benefit from it in some way, if you want to share that, that's great. If not, um, you know, use it as you see fit. Right. I certainly would never implore anyone to do something they didn't want to do. But yeah, that calendar strategy sounds pretty sweet, man. I love it. Cool. I hope so. I truly I hope so. I hope this. I mean, I hope this helps. Right. That's the whole. That's the reason I did this. So great. Yeah. Thank you so much. Okay. Some other stuff is coming through in the chat. Okay, third man. I plan to paper trade this for 30 days. And we'll take average allowed trade. It'd be great to try. Put on window scene. Awesome. Ace night gains. Cool, man. Love it. Or women. Sorry. Cool. Do it. Let me know how it goes. Maybe this thing. Maybe my own suckiness at process is actually my saving grace. I don't know. As far as the data is concerned, I looked at March 2021 until the last data file made available, which I think was June or July. And that's where all this came from. Ace net gains. Another comment. Dan, set a trailing stop loss. I would if I could. Tastyworks doesn't have them, and I should. That has come up before. Great, thank you. You are correct. A trailing stop loss is definitely the way to go. So maybe I need to call up Sosnoff and say, "Hey, brother, I need a trailing stop loss, or I'm gonna take my talents." And I use talents very, very lightly to TD Ameritrade or something like that. Someone who can give me a trailing stop loss. Schwab, I guess, I don't know. Yeah. Okay. How can you view my screen? Oh yeah, I'm sorry. I'm recording. I'm trying to record this as Zoom, but right now I'm not sharing my screen. You can check out the slides though. They're all over in the mix. And otherwise, just like DM me and I'll send you the slides. And eventually there will be a report on this that you can follow along as well. Okay, sound setting for Discord. Can you explain that in more detail? Calendar diagonal strategy. I will let the room collectively explain that because the diagonal strategy is out of my expertise right now. Learn about that another time. It's in depth. Yeah. Okay. Use the calendar, collect premium. Okay. Oh, he said he doesn't believe in him. Man, come on, dog. This would have been great. Bank of America just went on a total rip. I would have made a lot. I would have made more money. But it's selfish. Whatever. I love Tastyworks. Full disclosure, I like the Tasty trade strategy about like volatility reverting to the mean, and I like a lot of what they're doing. I love their platform too. It's so easy for me to like put on a spread, for me to go look at the curve to see what the profile looks like is absolutely fantastic for something I especially want to think about. But I would love it if they had a trailing stop loss. Yes, trailing stop can mean much better gains. Yeah, right, exactly. But Sosnoff doesn't like him, so that's going to be. It sounds like that's going to be a no, unfortunately for me, dog. But thank you, Alex, for giving me the scoop on the unfortunate the missing trailing stop loss there. Okay. Any other questions? God, I'm looking in the chat. no other raised hands right now. So I'll just like keep looking at the chat and seeing what's what. Give myself palpitations over the wheel strategy. This sounds like an ulcer in the making. Thanks for sharing. This strategy, hopefully I hope this strategy does not give you ulcers, because it is, as far as options go, it's like pretty chill, because they're so far out. The swings in price are not as drastic as also for the diagonal. Okay, yes, I haven't used any diagonals, so perhaps that would yield some ulcers. We will see. I'll let the collective group discuss that in more detail. See, okay, what do we have to say? Do you need us to explain? Pin the slides and spreadsheet to this channel or resource channel. Yeah, this is a great slow moving. It is slow moving. Truly, it is, like, as far as options are concerned, it's slow moving. But remember that, and I can't stress this enough, I only have 6 weeks of data for all of these. So as far as options go, yeah, it's pretty slow. A lot of people are like buying options, like same day, scalping options, doing all kinds of stuff. And I'm not picking on you, Ace Net Gains. That's a great comment, because it is like a slow moving strategy. But everything is expected to take place in inside of like 6 weeks, because that was all the history that I had, and that's why there's that big preponderance of things happening after 11 days. So maybe at some point I'll look at the date ranges in a little more depth, but I think that unfortunately it would be skewed with the longer date ranges because of that end of month problem that I mentioned before, where trades that occurred in maybe the last week of the month would only have like 2 or 3 weeks worth of data, and if they're a strict winner, it would just be whatever the end date was. It's a complex problem that I don't have a solution for. Would it be possible to see when the whales exit? Yes, you can probably. Yeah, okay, someone said open interest. That's exactly what it is. So you want to watch the volume and open interest on the contract, but I imagine if a whale is getting out in a hurry, then you're going to see your contract price change like very quickly. But if the whale is like slowly escaping, then you'll be able to see that by watching the volume and open interest. And wouldn't you know it, our amazing friends at Unusual Whales have made this remarkably easy to do. So if you'd like to track that, check this out. Like if you want to look at DraftKings, DKNG, if you click on that link right there, ticker flows, then at the bottom of that page, you can see, I think it's 90 days of history, which is great. Yeah, Snorlax, thank you. What an absolute king coming in with the history here. That's what you can see at the bottom of your page. So if you start to see a big swing in open interest, then you can pretty safely assume that the whale has exited and that you may also want to scoot on that trade. So you're actually swing trading with options with longer expirations. That's smart. I thank you. I don't want to really take any credit for it. Everybody else, like in the entire world, helped me do this, right? Like, the whale for releasing the data and alerting unusual things. But yes, essentially, I do think that's what the strategy is. It's like longer term swing trades with the benefit of leverage associated with options, and also taking advantage of the fact that the professional money that are generating these alerts probably has access to more research, more intelligence, better trade strategies than I have. So once they start going up, I can say, okay, great, cool. You are having success. I'm going to tail this trade and hope for the best. Okay, any other, all right, any hand raises? No hand raises. Okay. Some people are typing in the chat, so I'll hang out for another minute or two. Where can we find the PowerPoint? Oh yeah, totally. It is. I'm gonna click on share. Oh, sweet. Okay, thank you for sharing that up. Yep, that's where it is. Yes. Okay, and last little sweep here for questions, concerns. No raised hands in the room, which is fine. If anybody with questions, feel free to type them in. I will hang out here for another minute or two, and at 4:18 Chicago time, I'm going to roll out and resume doing day job work. My problem with options is still that I usually too focused on a shorter expiration, so I have higher leverage. That might be the deadly attitude. Maybe, right? I mean, I'm sure there's tons of successful people in here who make a ton of money trading shorter term options. It doesn't really work for me at this time in my life. So I was like, admittedly, this was like kind of a selfish research project because I was like, boy, I wish I could find a way to take advantage of these alerts that maybe take advantage of alerts that were not so fast moving, like intraday in and out kind of trades, because that can be very difficult for me to execute on depending on my work situation on any given day. Okay, cool. All right, great. So it has been exactly like 1 hour. So I'm going to go ahead and wrap it up. Thank you all so much for attending my rant and rave about this 181 DTE out of the money call strategy. The links are in the chat. The financial advice has not been given. This is not financial advice. Consult a financial professional with your investment strategy. And thank you all so much for wonderful questions. Thanks to everybody who jumped on and actually asked a question over voice or in the chat. I really appreciate it. And hopefully this whole the Zoom recording worked out really smooth, and I can put that up so people can see me going through the slides and answering questions live. And I hope everyone has a great Thursday. Have some fun on Friday and the weekend here, and I will be around in the chat. So don't hesitate to drop me an @ and I will speak with you all soon. Thanks.